Let me tell you a fun fact. Within the last 2 centuries, more than 90% of the world's millionaires have been created by investing in real estate. But if done incorrectly, without the right knowledge, required skills, or partners, it can also create a ton of problems and a lot of sleepless nights. You feel like sometimes there are way too many gurus out there trying to sell you on a weekend course, or just too much noise to cut right to the facts? Yup, we did too, and this is why we started this podcast. Our goal is to provide real estate investors, entrepreneurs, and enthusiasts with all of the most recent knowledge, secrets, tips, tricks, and tactics so that you can grow your own portfolios, increase your returns, net worth, and most importantly, create generational wealth for you and your loved ones. Remember, this is your real estate career. Information is your sword and shield, so eat hearty, prepare for battle, and grind your way to victory. My name is Tejas Gosai. I'm joined by my partner, Jeremy Moyer, and we welcome you to the Real Estate Investor MBA podcast.
Welcome back to Real Estate Investor MBA. My name is Jeremy Moyer, one of your hosts. My co-host Tejas and I both like to start off all our episodes with a big thank you to all our listeners. We could not do this without you. We enjoy hearing from you. If you'd like to give us a review on a specific topic, or even if you want us to kind of review a certain question, you can please send it to Jeremy at realestateinvestormba.com. Also, please be sure to check out our new website, rei.mba. You can find all our previous episodes there. If you're interested in following us or working with us directly, feel free to sign up with our newsletter. It's free to do so. So for our guest today we had Chad Griffiths, who has worked in the industrial real estate industry since 2004 as a member of a global commercial real estate company and a partner with his local firm. Chad has completed over 500 deals with clients ranging from small companies to large institutional owners. In addition to being the host of the Industrial Real Estate Show, Chad is honored to have been a guest on over 30 other real estate podcasts, as well as being interviewed numerous times by national media. Chad earned both SIOR and CCIM designations and holds an MBA, and is proud to have been recently named an industrial influencer by globalstreet.com. We just came out of a great interview with Chad just a few minutes ago, and wow, we cover a lot of great information ranging specifically regarding industrial investing, but really diving deep on a few topics. I really think you guys are going to enjoy today's episode. Enjoy. Welcome back to Real Estate Investor MBA. We're really excited for the guest that we have with us today, Chad Griffiths. Chad, how you doing?
I'm doing really well. It's an honor to be here. Thanks so much for having me on the show.
Absolutely. Well, we're excited to kind of dive into our topic today. But before we do that, for folks that aren't familiar with yourself, can you tell us who the real Chad Griffiths is and how you got started in real estate?
Yeah, thanks for that. And the real Chad doesn't have as red of a face as I do right now. As we were mentioning offline, I was at the lake yesterday and I got way too much sun. So hopefully I'm not emitting like some crazy a video aura on this, but normally my face wouldn't be this red. But I started in real estate in 2004, officially as an agent. I followed doing some house flipping with some friends, really saw an opportunity to do real estate as a career. I started in residential, did it for a year, really didn't see a long-term fit for it. So I went into commercial real estate in 2005. The brokerage that I joined just so happened to be involved in industrial real estate predominantly. So I had very little idea what industrial real estate even was. I thought I'd be working in office towers or retail. And just by pure accident, I stumbled into industrial, and very glad that I did, because now I guess we're 17, 18 years later. It's been an awesome career for me. I started investing myself in 2014, and with some partners and a lot of debt, we've accumulated a portfolio of about $20 million now. And I just live and breathe industrial real estate. I'm a full-on industrial real estate nerd. Got all my wealth invested in it. I follow it at a pure nerd level, always reading articles, always just trying to stay on top of trends, what's happening in the industry, because it's my career and it's where I've got everything invested. So it's gone from me stumbling into it to being really just a passion that I love talking about.
That's amazing. No, we love nerding out here on this show. So
Then I'm in the right place.
you're in the perfect place.
Awesome.
Yeah, perfect. Well, I appreciate that intro. So, for everybody today, we're going to primarily be discussing industrial investing. We haven't discussed this too often on the show, which we love finding experts like Chad that have a lot of experience, in this asset class, because it's a pretty hot topic and asset class right now with all the e-commerce and supply chain stuff, right? I mean, it's everywhere and anywhere, especially in our specific location, Lehigh Valley. There's so much industrial properties and buildings being built. It's really interesting to learn about. So, Chad, to kick everything off, you kind of touched why the asset class, you started working in the commercial brokerage, but what attracts you to this asset class, industrial, over multifamily, self-storage, etc.?
Well, I guess I could answer that from the lens of a broker or a lens of an investor. As a broker, I really had no idea. Like, I think what a lot of people that don't have familiarity with industrial real estate, call it pre 3 or 4 years ago, where it became more of a table topic where people could discuss it at the family dinner table, and supply chain issues and everything that comes with the news that we've heard percolating over the last few years. Prior to that, very few people had any idea about what it was. One a person that said it very eloquently, which I stole from him. So he said, the only thing I know about industrial real estate is when I make a wrong turn off the highway and I end up in an industrial park and I just try and find my way back to the main road. I think that sums up what a lot of people think about it. From a broker, I've liked the standpoint that you're working with companies that actually make stuff. Mm-hmm. So as opposed to it being perhaps an office or a retailer where they sell stuff or they're working on the back end from an administration standpoint, in industrial real estate, you're getting to walk through awesome factories or warehouses or distribution centers all the time. And to me, that was just really exciting. You got to work with small mom and pop companies all the way up to Fortune 500 companies that were responsible for greasing the wheels of commerce. So I really just like that from the standpoint that it was very exciting. You got to see how a lot of these things were made. Some of these factories are just very exciting at how they're made and how the process of things coming in from raw materials are manufactured with automation or robotics or any number of things, and then it gets sent out. I just really like that as a broker. As an investor, I think what appealed to me about it the most is that, for the large part, and it can vary everywhere, whether you're in Lehigh Valley or whether you're in California or whether you're in my neck of the woods, it can vary somewhat, but for the most part, you're going to be dealing with companies that are going to sign longer term leases. It's not uncommon to see a 5, 10, 15-year lease, and it's a lot easier to scale your portfolio. An example I like to give is one property that we have in our portfolio is about a $3 million property, and it's a single tenant that occupies it. And it's a Fortune 1000 company that's in there. It's a large French company that has a manufacturing arm, which is in our particular building. And it's one tenant that occupies a $3 million asset, and they're a Fortune 1000 company. So we have no problems or concerns about them being able to pay their rent. Now, if you were to take that and compare that to a multifamily property, $3 million multifamily property, you're probably going to need anywhere from 10, 20 residential tenants in there. And that just comes with a lot of management to oversee all those tenants. And the trade-off would be some diversification. If our tenant left, we'd have 100% of our cash flow gone, whereas one residential tenant leaves, you still have that diversification from other tenants. But from a management standpoint, it's so much easier for us to manage one tenant versus managing 15 to 20 residential tenants. So it's allowed us to scale our portfolio without having to become very management intensive on a day-to-day basis. We're our partners, for the most part, my main partner is a broker as well. And then we've got other partners that have careers and they have professions, and what we do on a day-to-day basis isn't impacted by us having to deal with a toilet leaking at 10 o'clock at night, using the cliche that I'm sure everybody complains about. I'm not anti-multifamily by any means. I've found that industrial has allowed us to scale a lot more, have a lot more confidence in the fact that we don't have as much turnover as would be found in residential, and it just doesn't take that day-to-day management that's required. So those would be the two main reasons. There's a lot of other benefits that I found as well, and there's also drawbacks, but in terms of you need to put your money to work somehow. My career as a broker, I don't have a pension, so my investment thesis is that I want to build up enough of a portfolio that my cash flow can replace my income at some point, and then ride off into the sunset.
No, I love what you just said there. Like, There's definitely pros and cons, right? And that's to any asset class, right? I mean,
Absolutely.
I like to think about, not that we all invest in the stock market. The stock market's crazy right now, but we talk about alternative investments, right? And that's real estate. I always like to dumb it down in my head of like, your high risk stocks, your blue chip stocks, and then your bonds or whatnot. And like I try to extrapolate that to different portfolios or asset classes in real estate. I mean, some are more stable, typically your triple net type leases, your longer term leases, they might be your more stable, less management, but you might not be able to get those returns that you would be able to maybe in a mobile home park or, multifamily. But every asset class in a portfolio could have a position, and it's all about determining what is right for you. Every investor situation is a little different. So I really enjoyed that what you just said there with the benefits of it, because, the more I look into it personally, I'm very intrigued in industrial. I'm heavily into multifamily right now, but I like to have a hedge, and not put all my eggs in one basket. And that's very cliche, right? But just to look at, well, if this turns over here in the economy, what could still be strong, right? And it's just kind of seeing what works, that give and pull. But you brought up leases, and I want to kind of get into the topic of leases. With especially a single tenant building, maybe two tenants in a building, three tenants in a building, the leases, I'm sure, are extremely important. They're longer term, considerably less turnover. One, I guess, negative that I've heard in office or retail, and maybe even extends to industrial, is what happens if they leave? What assurances do you have in the leases, et cetera, like that? So can you walk, the listeners through how important leases are in your due diligence? What are you looking for? What are red flags? What are strengths? Obviously, the quality of the tenant is very important. So can you speak to that a little bit?
Yeah, and I'm glad you brought that up, because that does speak to a fundamental risk of investing in industrial real estate. And the last thing I'd want to do is paint this picture that industrial real estate is the perfect investment vehicle, because it's not.
Yep.
It comes with a corresponding amount of risk. And I look at it as like a pendulum. Like if on any investment, you've got upside potential and then you've got downside risk. And I think any prudent investor tries to balance that pendulum. So if you're looking at downside risk of, call it 20%, you should have upside risk somewhere in that 20% as well. And not to go too far down the road on this tangent before I answer your question, but to me, it's crazy that someone would consider a 40 or 50% downside risk to try and make a 10% upside. To me, that's just crazy. I think that you really do need to balance that pendulum. Metaphorically speaking. But on the topic of leases, that's a great point, is that you're right. A lot of companies don't necessarily have the financial wherewithal to withstand certain pressures. And what we went through over this past couple of years was a good example for some tenants that just couldn't weather that storm. Some got bailouts from the government and all the free money that was printed, but there's companies that just didn't make it. And I think that speaks to one of the biggest risks in my mind with industrial real estate, is that if you have a single tenant building and that tenant does leave for whatever reason, perhaps they go bankrupt, perhaps they do a midnight move, perhaps their lease just comes up and they decide not to renew. If that building isn't compatible for the next tenant that's going to go in there, it can take either a significant amount of time to find a new tenant, or it can take a significant amount of money to retrofit it to make it compatible for the next tenant. And both of those are scenarios which have a huge impact on cash flow. So that, in my mind, is the biggest risk. So what I try to do to mitigate my downside risk on any property that I evaluate is I actually look at it as if the property were vacant. Even if there's a 5-year tenant in there with a Fortune 1000 company, which speaks to the property that we have, even if that tenant doesn't renew at some point, I want to go through the exercise of determining what that building is worth if it were vacant. Because in 5 years, it very well could be. And I think if you go through that exercise, you start looking, are there any impediments in that building? Or perhaps are there low ceiling heights, as an example? That tenant that's in there right now might not have cared, but what does the market say? Does the market say, and market, I'm speaking collectively of the next batch of tenants that will consider this, do they want higher ceiling heights? And if they want higher ceiling heights, what kind of impediment is that building that I have right now? And what do I have to lease that space at? Or what do I have to put money into that space down the road? And if I don't have that in mind, then I can be stuck with a huge sticker shock when it comes to addressing that issue down the road. But going through that exercise of determining what's this building worth if it were vacant, then I can start getting ahead of all these problems, and I can start really evaluating what that property is worth. Because the lease as it stands with that existing lease with that existing tenant is undeniably important. I'm buying that cash flow for a large part, but I also need to have that protection that if that lease ends at some point, I need to have the confidence that I can release it to another tenant. So I think that that's where industrial real estate carries the biggest risk. And it's a risk unlike any other asset class. Multifamily, if you have a 2-bedroom unit in a good market, you know you're always going to have a tenant for that. Maybe you have to lower the lease rate $100 to be attractive, pull some levers here and there. You're always going to have a tenant in that market if you're in a good market. Same with office space, same with retail. You can find another tenant for there because they're not completely different. An office in your market is not that much different than an office in my market. But if you have a manufacturing property that perhaps was specifically built for the company that's in there right now, and perhaps it just has a lot of customized build out and machinery, and maybe the layout was built specific to their use, that property might not be compatible for the next round of tenants that go in there. So knowing what the drawbacks are, the limitations, any of the functional obsolescence that appraisers like to talk about, if you have a really good understanding of what that property is and what it isn't, then I think you're in a position to capitalize on that as an investment. But that does take a considerable amount of work to do. And I could speak of graveyards of stories of people who didn't go through that exercise and significantly got burnt on it down the road.
No, that makes a tremendous amount of sense. How important are corporate assurances, or, like the lease is backed up by, like, is more retail, but I'm just thinking Starbucks in the back of my head, like, corporate Starbucks, they assure that the lease will be paid. But like from an industrial standpoint of view, I'm sure there's corporations that are such like that. How important is that? And then also at the same time, the length of leases, like if leases come up for renewal, like what length of term as an operator are you looking to achieve? I'm sure the building and the tenant drive that, but just in generalities, if you could speak to that a little bit.
Yeah, great point. And I think that without speaking in complete generalities, because I don't want to make a blanket statement here, but generally speaking, the larger the company, the more aggressive that they're going to be on the lease rate. So there's a bit of a trade-off there where, yes, you have the confidence that it could be like Schlumberger, like a big company that has like a Fortune, I don't even know where they're on the Fortune scale, but I'm assuming they're in the Fortune 100. You have a big company like that as your tenant, you've got confidence that they're going to be able to pay their rent. The trade-off is that they're probably going to be a lot more aggressive negotiating their lease versus leasing it to a company that perhaps is like a smaller medium business where you might have to take a little bit of a chance on them. It's undeniably important, and I don't want to underscore that, but there just is a somewhat of a trade-off there between having a really large company and perhaps getting a higher lease rate with a company that isn't as large. I'm in between. Like in our portfolio, we have small mom and pop companies that if you can go through their financial statements and get a high level degree of comfort that they're making money, they're saving money in retained earnings, they've got an expense line item that shows that they can afford their rent that they have been paying historically. I'm one of those investors that's comfortable taking a little bit of a risk on those companies. There's large institutional landlords that won't take that same amount of risk. They're going to want to be very calculating on exactly who the company is. They're going to want to underwrite that company to make sure they know exactly how large that company is and their ability to pay rent. So I'd say it's on a spectrum to some point. There's smaller investors like myself who are going to be more risk tolerant. There's larger investors that are going to try and really get the best quality tenant that they can. Lease term's another interesting one as well, because interestingly, over the last couple of years, there's actually been a move away from having these longer term leases to some landlords actually preferring shorter term leases from the pure standpoint that inflation and just rental rates are increasing at such a rate that if you lock in a tenant for 5 or 10 years, you don't have the ability to reprice it if the market goes up so much. And we might be entering into a new part of the cycle where that changes. But at least over the last couple of years, landlords have been sensitive to not underpricing their asset or locking in that price for some amount of time. So we have seen some people do shorter term. I still like having some comfort that I don't have all my leases coming up at one point, and I'm faced with a task of making all the payments and having to run all the properties with a vacant portfolio. So I think you could look at that as a spectrum. Some landlords are going to be comfortable doing a year-to-year or even a month-to-month lease and trying to capture that potential upside. Some are still going to prefer that 5 to 10, 15-year leases.
No, that makes a tremendous amount of sense. So we talked about leases ad nauseum. I think we'll move on from that. You touched base upon, we obviously review the leases, underwriting the tenant, underwriting and looking into who that other tenant might be if they left, acting as if the property's vacant, looking at the obsolescence of the property. Is there any, one more key due diligence item specifically on the property, or maybe even another item on the tenant, what like you could share with our listeners?
Well, I guess we could even look at it from the standpoint of the due diligence on buying a property. And I'd assume that most people would be buying property with debt. And anytime you involve a lender, they're going to have a set list of criteria that you're going to need to meet. But even if it was an investor considering buying all cash, I think you still want to go through that same due diligence as if it was a lender involved, and a lender's going to have all their requirements. So basic things that I'd always say that you want to have with any industrial property, you want to have a building condition assessment or a property condition assessment. And that's basically just a report where they go into every detail about the property, HVAC systems, electrical, foundation, everything related to that property. And then they also give a scope on how long those systems or mechanics are going to last, and an estimated cost to prepare for it. So in a perfect world, you have your building condition assessment, or your BCA, tells you all the issues that are coming up, and it gives you a cost that you can expect over some period of time. And that's important, obviously, for a lender, because if they have to take that property back, they want to know what they're going to have to spend to rectify any potential issues. But that's also very important as an investor, even if there wasn't a lender. So I'd definitely say you want to get a BCA, you want to get an appraisal, just so you have a neutral third-party report on what that property is worth. You're going to need that if it's a lender. I think it's prudent to have, even if you don't have a lender. And then an environmental site assessment, which isn't common in residential, office, or retail. You might still need one depending on where you are for retail and office, but industrial, you absolutely need an environmental site assessment. And there's different phases of it, but the first phase that you definitely want to do is just an environmental phase 1, which is just a historical search of the property to make sure that there's no indication that there might be contamination on the property. The environmental technician will do a walkthrough of the property, see if there's any visual signs. And if nothing comes back concerning to them, they'll typically write something along the lines that there's no further testing recommended. As it goes through the stages, then you actually start testing the soil, goes to a lab, they see if there's any contamination in there. Then you go through a phase 3, phase 4, where you actually come up with a plan and rectify it. Those costs can become insanely expensive. Like in some worst case scenarios, you might be looking at millions of dollars to remediate a property with contamination. I've never been involved with one at that level myself. I'd like phase 1 environmental saying there's no further testing recommended. But if you don't have one of those, if you don't have one of those reports and you're buying a property with contamination, again, you're just opening yourself up for a huge amount of downside risk. So the appraisal you'll need if you're doing lending, but even if you're just buying it as a cash property, I would definitely have a BCA, and I'd definitely have an environmental site assessment.
No, those are tremendous suggestions. I appreciate that. I'm sure you can speak to a lot of potential missteps or mistakes investors can make along this road investing in these type of properties. But can you think of, just share one common mistake that you might see, or you do see investors making, especially if they are just starting investing in industrial properties?
The biggest one that I see is that investors buy based on current cash flow. So they'll buy a property that, call it 5 years left on the lease, and they've got a good tenant in there and it's paying a good amount of rent, and they feel confident that the market's going to be strong, but they don't underwrite that downside risk. And that is the biggest one that I've seen where people just don't factor in what that property is worth if it's vacant. So it's tempting to look at 5 years is a lot of time to earn cash flow, but that 5 years also comes up pretty quick. And if you don't have a plan for what that property is worth when it's vacant, it can destroy a lot of wealth.
Yeah, that's great. I appreciate that. That determining what it is like vacant, is it working with a commercial broker, trying to go into the property, looking at, like you mentioned before, if there's any obsolescence, physical parameters of the building, and seeing what the market would be if you had to re-rent it? Would the broker be a crucial person on your team to help you with that?
I think so. I mean, I would definitely be pro broker just from the standpoint that I am a broker,
Sure.
but I think it could largely be done. I should even actually explain that a different way. I think the investor should be able to do it without a broker, as contrarian as that may sound, because I think the investor should know that much about the industry that they have similar levels of knowledge with that broker. Because I think industrial real estate needs to be one of those investment vehicles that you need to be hands-on. You need to know what's happening in the market. You need to know trends. You need to know what tenants like in it, what ceiling heights are desired in the market. And this comes just by following along with the market. What properties have just sold recently? What properties have just leased? And really discovering what happened on that property. A lot of this information is actually available if you're looking to see, if you owned a property in Lehigh and it was called a 30,000 square foot building, it's very easy for you to find all the other plus or minus 30,000 square foot buildings in that area and just see, well, what are the ceiling heights? What's the loading area? What type of loading doors are in there? How much power is coming into the building? And I think that instead of actually just relying exclusively on a broker, look at a broker to perhaps corroborate what you think, as opposed to giving you all that information and then just taking it at face value. I think it's incumbent on a smart, prudent investor to learn all those things on their own, as opposed to just relying on it for third parties. So I would say this isn't a hands-off investment vehicle unless you're going the syndicate route and you're just going along as a limited partner. If you want to actively own industrial real estate, I think you need to be fully engaged with it.
No, that's perfect. Thanks for sharing that. So as we're closing near the end of the show, Chad, we cycle through a bunch of closing questions. And the one that I have up for today is, and I think it's a piggyback off of that last question, but let's say our listener, hasn't started investing in industrial. They maybe invest in other different asset classes, but they like the idea of diversifying within the real estate asset classes. What's one piece of advice, after listening to the episode today, that's actionable that they could do, that just gets them, they can start doing tomorrow, right? That gets them one step closer to their first industrial deal?
First thing I always recommend is start driving the industrial areas in the market that you want to invest. So Lehigh Valley, take a weekend where industrial parks are traditionally slower and just start driving. Drive up and down every road, take notice of the companies that are in there, start taking notice of what type of properties they are, what sizes they are, what type of loading doors. You can see all of this from the exterior just from doing a drive, and it'll open your eyes to not just the industrial real estate landscape, but just how big it is. Because there's companies you'll see that you never knew existed. The scale of businesses in these industrial parks, which most people have had no reason to go into unless they get lost off the highway like that earlier one. It opens your eyes to how large the industrial real estate market is. And if that sparks a curiosity for you, then start diving into it. Start reading market reports on what's happening in your specific market. Start understanding what tenants want in a building. Just be a sponge for information and be patient, because I don't think you want to rush into this either. That's mistakes get made when people make hasty decisions. But see if you get a curiosity for it. I did. I had no idea what industrial real estate was before I got into it, and took me down this long journey now. But if it sparks that curiosity, just be prepared to spend time and develop it as like an interest or as a hobby, as something you could get excited about. And I think if you can combine that with appetite to just want to get into a different asset class and you become as educated as you possibly can about it, I think you've got a high degree of success for this.
Perfect. Well, in closing, Chad, how can our listeners get in touch with you?
I got a YouTube channel where I love talking about industrial real estate, as you could tell. So it's channel, I believe, is Chad Griffiths CRE. But if you just search industrial real estate on YouTube, it'll come up for me. Or LinkedIn or email is great as well. Email is griffithscre@gmail.com. And I try to answer every email that I get to.
Perfect. Well, Chad, once again, thanks so much for your time today. This is Jeremy Moyer with Real Estate Investor MBA. Please be sure to tune us with next time. We'll see you then. Thank you.
Thanks, Jeremy.